I was thinking on the drive-in today about what actually makes a business truly fascinating. We spend so much time obsessing over the next big thing, AI, space travel, quantum computing. But usually, the businesses that are the most interesting to dig into are the ones that are, well, totally invisible. I'm talking about the stuff you walk past every single day without giving it a second glance.
The paradox of infrastructure. We only notice it when it breaks.
Yes.
And when it breaks, it suddenly becomes the most important thing in the world.
Exactly. The pipes, the ductwork, the air handlers, the stuff humming behind the walls. Today, we are doing a deep dive into a company that lives entirely in that invisible world. We're talking about Limbach Holdings, ticker symbol LMB. Now, if you just glance at their website or see their trucks on the highway, you see hard hats and safety vests. You assume, okay, standard construction company, they pour concrete, they hang steel.
But that assumption is exactly where the opportunity lies. Because we have a stack of documents here, Q3 2025 earnings, strategy decks, acquisition reports, that tell a completely different story. This isn't really a construction company anymore.
It feels more like a disguise.
It is a bit of a disguise. The central tension of this entire story is that Limbach is currently in the middle of a massive identity crisis, but in a good way. They are trying to convince Wall Street that they have evolved from a low-margin subcontractor into a high-margin, mission-critical service partner.
And that distinction isn't just semantics or corporate buzzwords. It's the difference between a stock that trades at a construction multiple, which is usually pretty low, and one that trades at a service multiple, which is significantly higher.
Precisely. So our mission today is to look under the hood of this transformation. We need to figure out how a company manages to pivot its entire business model while the plane is still flying, whether they are actually pulling it off, and if the market is actually buying what they're selling.
Okay, so let's start with the before picture to set the stage. If we went back just 5 or 6 years ago, what was Limbach?
You would have seen a classic GCR business.
GCR. Let's break that down.
General contractor relationships. In the construction world, this is the traditional hierarchy. A big general contractor wins a bid to build a massive stadium, a skyscraper, or a terminal at an airport. They then hire Limbach to do the HVAC, the plumbing, or the electrical work. Limbach is the subcontractor.
So they are essentially the hired help for the hired help.
In a sense, yes. And economically, that is a brutal place to exist. Think about the mechanics of it. You get the work through competitive bidding. You are fighting against 5 or 6 other firms to offer the lowest price. That dynamic naturally compresses your margins. Historically, this work sits in the low 20% gross margin range, often even lower.
And you're taking on all the risk, right? If the price of copper goes up or if the project gets delayed because of weather, that's your problem.
It's high risk, low reward. And it's incredibly cyclical. If the economy turns south and developers stop building new office towers, that revenue stream just evaporates. It's feast or famine.
So Limbach looked at this model, this GCR model, and said, no thanks, we need a new diet.
They said, we need better calories. They started an aggressive shift toward what they call ODR.
ODR. Let's unpack that acronym because that seems to be the engine here.
Owner-direct relationships. This is the pivot. Instead of waiting for a general contractor to call them for a new build, Limbach goes directly to the building owner, the hospital CEO, the facility manager, the university president, and says, let us manage your systems directly.
So they are cutting out the middleman entirely.
Completely. And the speed of this shift is actually shocking. If you look at the data from 2019, ODR was essentially a side hustle. It was less than 21% of their revenue.
Less than a quarter. So they were overwhelmingly a construction subcontractor.
Fast forward to the third quarter of 2025, and ODR now makes up 76.6% of their total revenue.
Whoa, that is a massive swing. In corporate terms, that's basically a lung transplant. You've changed the entire DNA of the organization in just a few years.
And they did it because the economics are just undeniable. ODR margins are significantly stickier and higher. Year-to-date in 2025, their ODR gross margins were around 27.4%. Compare that to the GCR side, which drags behind at roughly 23.3%.
4 points of margin is huge in this industry. That flows right to the bottom line.
It separates struggling from thriving. And it's not just the margin percentage, it's the cash flow. In construction GCR work, you might wait 90, sometimes 120 days to get paid by the general contractor. With owner direct, you bill the client directly, and the check clears much faster.
Plus, and this is the big one for me, it decouples them from the construction cycle. If we hit a recession, nobody builds a new headquarters. But they definitely still need to fix the AC in the old one.
Exactly. It's recession resilience. But I want to pause on the what for a second and dig into the how, because I think there's a misconception about what owner direct actually means.
Yeah, when I hear direct relationship or service, I just picture a guy in a van coming to fix a leaky faucet or unclog a drain. Is that what's driving a multi-million-dollar public company? Just fixing leaks?
That's the handyman fallacy. It's much more sophisticated than that. If we deconstruct that ODR revenue block from their latest reports, it's actually three distinct streams. First, you have maintenance contracts.
The Holy Grail, recurring revenue.
Right. These are typically 1 to 3 year agreements. We check the filters, we monitor the sensors, we do the preventative stuff. It provides a base layer of predictable income that covers the overhead, but that's just the baseline. The second stream is where it gets really interesting. Work orders and T and M time and materials.
You mentioned earlier this is called quick burning revenue.
Yes. This includes emergency repairs, sure. If a boiler blows in January, you call Limbach. But the big money here is in something called industrial shutdown work.
Shutdown. That sounds ominous. Usually when a business shuts down, they're losing money.
In this context, it's planned chaos. Think about a massive food processing plant or a pharmaceutical manufacturing line. They run 24/7. They can't fix things while the line is moving. So once a year, or maybe twice a year, they schedule a shutdown. They turn everything off for 5 days.
And the clock starts ticking immediately.
Exactly. Every hour that plant is down costs the owner thousands, maybe millions in lost production. So Limbach comes in with an army of technicians. It's high-intensity, high-velocity work. They overhaul systems, replace valves, upgrade piping, all on a tight deadline. It's extremely profitable because the client isn't price-sensitive, they are time-sensitive.
They just need it done now. They aren't going to haggle over the hourly rate when the factory floor is silent.
Correct. So that's the second bucket. Now, the third bucket is fixed-price projects. But here's the key data point from the documents. The average size of these projects is about $245,000.
$245,000. In the world of commercial construction, that's tiny. That's a rounding error on a skyscraper project.
It is small, and that is the entire point. In the old GCR world, Limbach would bid on a $20 million ventilation system. If they miscalculated the labor costs on that one massive project, or if there was a delay, they could lose their shirt. It's binary risk.
It's swinging for the fences and striking out.
These $245,000 projects are singles and doubles. They're retrofits, replacing a chiller, upgrading a boiler system. They take a few weeks, not a few years. The velocity of capital is faster, and the risk is distributed across hundreds of small projects rather than 3 big ones.
It seems like they've moved from being a builder to being a consultant who happens to know how to use a wrench.
That's a great way to put it. The strategy deck actually uses the term consultative sales. They aren't waiting for the phone to ring. They are going to the C-suite of a hospital or university and saying, look, we benchmarked your energy usage. Your current system is inefficient. If you spend this capital now, this CapEx, you will save on operating expenses OpEx later.
They're turning a grudge purchase, oh no, the AC broke, into a strategic financial investment.
Correct. They help executives convert unpredictable emergency costs into predictable capital improvements.
It's financial engineering as much as mechanical engineering.
I want to circle back to the types of buildings they're working on. You mentioned hospitals. This is the mission-critical part of the thesis, right?
Yeah.
Because Limbach isn't trying to get the maintenance contract for the local strip mall.
No, absolutely not. That's a commodity game. Anyone with a truck can bid on the local strip mall. Limbach focuses strictly on verticals where system failure is catastrophic. Healthcare is the biggest one.
Because if the HVAC fails in an operating room, it's not just uncomfortable, it's dangerous. It's life or death. Infection control relies on air pressure differentials. You need positive pressure in the operating room to keep germs out and negative pressure in the quarantine ward to keep germs in. These are complex, highly regulated systems. If they go down, the hospital shuts down.
So the moat here is complexity.
Complexity and liability. A hospital administrator isn't going to hire the cheapest bidder to maintain the OR air handlers. They're going to hire the partner they trust. That gives Limbach pricing power.
What else fits into this mission-critical bucket besides healthcare?
Data centers. This is obviously huge right now.
The cloud needs to stay cool.
And as we move to AI, the heat generation from these chips is skyrocketing. Limbach isn't necessarily pouring the concrete for the new data center shell. That's the low-margin construction work. They are doing the specialty fabrication for the cooling loops in the existing ones or retrofitting older centers to handle new, hotter ships.
Keeping the servers from melting.
Exactly. Then you have industrial and manufacturing, like we touched on with the shutdown work.
Hmm.
If a food processing plant loses humidity control, the product spoils. And life sciences R&D labs, these are environments that require precision.
It's a defensive strategy. Even if the economy crashes, Pfizer can't let its lab samples spoil. Google can't let its servers overheat.
That is the argument. It insulates Limbach from the broader economic ups and downs. They are betting on the necessity of the infrastructure, not the expansion of it.
Okay, so we have organic growth, getting more wallet share from these hospital owners. But looking at the timeline, specifically July 2025, they made a pretty big move on the acquisition front. This isn't just an organic growth story.
No, this is the buy and build pillar of the strategy. The market they are in is very fragmented. You have hundreds of regional mechanical firms that are doing 10 million or 20 million in revenue. They're good businesses, but they are inefficient.
So Limbach buys them.
They look for regionally dominant firms, companies that have the relationships, but maybe not the operational sophistication. They buy them, usually in that $10 to $40 million range, and then they apply the Limbach playbook.
Which is?
It's a multi-year process. Phase 1, usually the first 1 to 2 years, is integration. Strip out costs, integrate the back office, get them on the same software. Phase 2, which is years 2 through 4, is the margin expansion. This is where they retrain the sales team to stop waiting for bids and start doing that consultative selling we talked about.
It's like flipping houses, but for engineering firms. You buy the fixer-upper, put in a new kitchen, and raise the value.
In a way. And the biggest house they've bought so far is a company called Pioneer Power. They closed this deal on July 1st, 2025.
What was the price tag?
$66.1 million.
That's a significant check. What did they get for that $66 million?
Geography and capability. Pioneer Power is based in the upper Midwest, specifically Minnesota. They are heavy hitters in the industrial and manufacturing space. Food processing, power generation, utilities. It really deepened Limbach's capabilities in that specific vertical.
But I was looking at the Q3 2025 report, and I noticed something that might spook a casual observer. The consolidated gross margin actually dipped a bit, down to 24.2%. If the strategy is high margin, why did the margin go down?
That is the friction of the buy and build model. It's a math problem. Pioneer Power, at the time of purchase, had lower margins than Limbach's core business.
So when you blend them in, it dilutes the overall pool.
Temporarily, yes. And management was very open about this. They basically said, we bought a lower margin business, and now our job is to fix it.
So we are currently in phase 1 with Pioneer.
Correct. They are betting and asking investors to bet that over the next 12 to 24 months, they can lift Pioneer's margins from the low 20s up to that 25+% target that the rest of the company enjoys.
It's an arbitrage play. Buy the earnings stream cheap because it's inefficient, make it efficient, and suddenly that purchase price looks like a steal.
That's the theory. But it creates noise in the short-term numbers. If you just looked at the margin drop without context, you might think the business is deteriorating. But it's actually a sign of digestion.
Which brings us to the big picture, the investment thesis. We have a company that has pivoted 76% of its revenue to high-margin service work. They're buying in companies to grow. But how is the market treating them?
This is the valuation gap, or what some analysts call the valuation arbitrage.
Yeah.
Historically, the market priced Limbach like a construction firm. Construction firms usually trade at low multiples, maybe 6 to 8 times EBITDA, because they are risky.
Boom and bust. You don't pay a premium for that.
But Limbach is screaming, we aren't that anymore. They want to be priced like a resilient service platform. If you look at a peer like Comfort Systems USA, they trade at a significant premium because the market views them as a service compounder.
So where's Limbach trading relative to that?
Based on the data we have here, they are trading at around 11.8 times forward EV to EBITDA. The thesis is pretty simple. If the market eventually agrees that Limbach is a service company and not a construction company, that multiple should expand.
That's the re-raving opportunity. You buy it as a construction stock, hold it, and eventually sell it as a service stock.
That's the bet, and the financial health supports it. For fiscal year 2025, they've guided for revenue between $650 and $680 million, with adjusted EBITDA between $80 and $86 million.
And what about cash? Are they burning cash to fund these acquisitions?
No, they have a very strong balance sheet. They target a 75% free cash flow conversion. Essentially, for every dollar of profit they report, 75 cents actually hits the bank account. That is high-quality earnings.
And I saw they authorized a share repurchase program in December 2025.
$50 million. dollars.
That's a strong signal. Management is effectively saying, we think our stock is cheap enough that buying it back is a better use of cash than almost anything else.
Or at least that they have enough liquidity to do both buy back stock and buy new companies. It's a flex. It shows they aren't worried about keeping the lights on.
Okay, we've painted a pretty rosy picture here. Transformation, margins up, recession-proof hospitals, smart acquisitions. But I'm the skeptic. What's the catch? What keeps the CEO up at night?
Execution risk. It's always execution risk. Integrating a company the size of Pioneer Power isn't just about spreadsheets. It's about people, cultural clashes,
Yeah.
systems integration. If the Pioneer employees reject the new Limbach way of doing things, that margin recovery we talked about, it never happens.
And what about the revenue mix? We talked about quick burn work. Is that a double-edged sword?
It is. Think about the old GCR days. You had a backlog that stretched out for 2 years. You knew exactly what your revenue would be in 18 months because you had a signed contract to build a stadium.
High visibility. You could sleep easy knowing the work was booked.
With ODR, specifically the T&M and quick turn projects, your visibility shrinks. You rely on the phone ringing. You rely on those relationships remaining sticky. If the hospital administrator retires and the new guy brings in his own vendor, that revenue disappears overnight.
So you are trading long-term visibility for short-term profitability.
That's a fair way to put it. They are betting that the mission-critical nature of the work means the phone will always ring. But the risk profile has changed. It's less about will the economy crash and more about can we keep our customers happy every single day.
And let's not forget the labor market. This entire model relies on having skilled technicians who can fix complex systems. There isn't exactly a surplus of those people right now.
The war for talent is real. If they can't hire enough techs, they can't grow. That's a hard ceiling on their expansion. They can buy all the companies they want, but if they don't have the bodies to do the shutdown work, the revenue stops.
So to wrap this up, we have a company that used to just follow the blueprints, and now they're trying to write the playbook for building maintenance.
They've essentially stopped building new buildings so they can focus on keeping the old critical ones running. It's a shift from growth at all costs to quality of earnings.
And the market is still deciding if they believe it.
That's the fascinating part. Limbach is telling the market, look at our margins, look at our ODR mix, we are a high-value consultant. And the market is looking at the hard hats and saying, you still look like a blue-collar builder to me.
A show-me story.
Exactly. The question for the listener is, has the proof already been delivered? Or is that arbitrage window, the gap between perception and reality, still wide open?
A question worth asking the next time you walk into a hospital and enjoy the fact that the air conditioning is working perfectly.
Indeed.
That's it for this deep dive into Limbach Holdings. Stay curious about the systems humming behind the walls, and we'll catch you on the next one.